Everyone says, don't buy a new build. You will end up in negative equity. But you know what? I actually love new builds. And I've got solid reasons why. I hope you understand. That said, the risk of losing money is real. In this video, I'm going to explain why I prefer new builds, the hidden trap of negative equity, and most importantly, how you can avoid it, even if you are set on buying a new build. Okay? Let's get right into it. Welcome back to FameBright channel. I am glad to have you here. Okay? Why do I love new builds? I will tell you everything that is good about new build. Let me start with the positive vibes, okay? Because new builds get a bad rep online, and it's not always fair, to be honest. It's not always fair. Number one reason is this: there is no renovation hassles. I love the peace of mind that comes with walking into a freshly finished home. No damp walls, no ancient boilers, no wallpapers. You know, because most times I keep thinking, who knows what has happened behind those wallpapers? Could there be a cracked wall? Could there be a damp wall? Could there be molds hiding behind those wallpapers? Another reason I love the new builds is this: the energy efficiency is superb. New builds are built to modern standards. The EPC ratings are usually A or B, and that means lower energy bills, better insulation, and even eligibility for green mortgage products. I'm always chilly. I get cold so easily, so I love the house warm, especially during winter. So this is a good one for me. It ranks high in my priority. Another reason I love the new build is this: when you buy a new build, they give you warranty and safety, okay? 10-year or equivalent warranties, and it gives you confidence. All the electrics and fire safety systems, they meet the latest codes. So that's a good one. Any structural damage that happens within that 10 years, they are going to take care of it. Another reason is this: modern layouts. New builds are made for today. They've got this open plan kitchens, built-in storage, USB plug sockets, you know. So yes, I'm team new builds, but not blindly. I also understand the risks, and that's what we are getting into next. Now, what is negative equity? Negative equity happens when you owe more on your mortgage than your home is worth. So let's say you buy a car for 30,000, and a year later the car is now worth 24,000, but you are still owing 28,000 on that car because you've only been able to pay off 2,000 out of the 30,000. But hey, you don't have any control over the worth of the car or the value of the car. It is now 26,000. It is what it is. You are still owing more than the worth of the car. Anyway, this is not a real example because, I mean, of course, in reality, a car is a liability. We all know that anytime you buy a car, it reduces in value, no matter how new it is. But it's not always like that in a house. But anyway, this is just an example. I hope you understand. Another example I can give is this: let's say you bought a new build house for £300,000 and you used Help to Buy, which means you did 5% deposit of £15,000. After 2 years, the market value probably drops to 270,000, but your mortgage is still 285,000. That means you are now in 15,000 negative equity. Now, this becomes a serious issue if you want to remortgage, if you need to sell, or if the interest rates rise and your monthly payment jumps. Okay. So I hope you are understanding where we are going with this and how it affects you if it happens anyway. Now, the question is this: why does this negative equity always happen with new builds? The most common reason is this: of course, you are paying for a new build premium, okay? Just like when you buy a brand new car, a brand new car will lose its value after you drive it out from the seller's shop. It has already reduced its value. Now, for a new build, because you are the first person living there, you are going to enjoy all that luxury. You know, the fact that it is a new build, nobody has lived in that house, it is sparkling, it is clean, you design it and decorate it exactly the way you love it. It is all yours. So most of the times they are priced a little bit higher than what it should be. I mean, if you check the other houses in that neighborhood, it could be a little bit pricier than the others. So you understand where we are coming from. So if after some years now you have lived in that house, it is no longer a new build, it will now come down to the same price as mostly all the other houses in that area. So just know this: you are paying for those shiny bits. But anyway, I have to mention this: this does not really happen all the time. It doesn't happen as often as people want us to believe. Just like I will always say, when you are buying or investing in a property, just consider it an investment. Okay, consider it an investment, and every investment there is a pattern to it. It could go up, it could come down. So don't just fix your mind on whatever it is you are going to gain on the short term. Fix your mind on the long term, and whatever happens, always know that for every investment there is that risk. No matter how little it is, there is that risk that you may lose whatever it is that you have invested. I hope you know that. So always have that somewhere in your mind, and always remember that it is not as common as people make it seem. Okay, so don't always focus on the negative. Now, another thing that may cause this is because incentives inflate the price. Okay, for instance, in a new build you'll find free appliances. They may pay for your stamp duty, depending on the housing association and the package they come with. Some of them may pay the remaining 5% for you. They come with a whole lot of package to entice you, and all these things could inflate the price when you are buying the new build. So eventually the price will have to come down to the neighborhood. It will have to be competitive eventually, because it is no longer a new build after you have lived in it. All this will artificially inflate the price of the property. So it is not always the real resale value, and that is why each time you want to sell the property, you have to revalue the property to know exactly what it is in the market. Now, another thing that could cause a property to have a negative equity is this. There could be oversupply in a development area. So let's assume that they are building a whole lot of new builds in that area, and demand is not as high as supply. Of course, the demand and supply thing. So if demand is not as much as supply, and there are lots of new builds in that area, then the houses in there, the prices will be forced down. Do you get that? The house, and this is not just applicable to a new build, this is also applicable to old builds. Supply and demand will always influence the prices of goods. So house prices are not any different. So for example, in big new estates, 50 nearly identical flats or houses go on sale at the same time. When multiple owners try to sell it, it will drive the prices down. That's just it. Another reason is this: weak secondary market. New builds are popular with first-time buyers, but when it's time to resell, they are competing against newer builds, okay, or older, more spacious home in better locations. So you see, all of these things, a whole lot of things can affect the price of a building. Now, how do you buy new builds wisely? Let's get practical, because I believe in solutions. I'm not here to just scare people. I don't believe in scare tactics, okay? Here's how you can protect yourself if you are buying a new build. Number one thing to do is try as much as possible to put down a bigger deposit. You can put down at least 15 to 20% deposit. It gives you a buffer. It also reduces the risk of falling into negative equity if prices dip. Now, my advice is this: if you are struggling to save up a huge amount of deposit so that you can step into the property ladder, you can also consider the shared ownership. I've made a concise video on shared ownership. Please do well to watch it. The game changer is this: as much as possible, and this I advise this not just for new builds, whether it's new build, whether it's old build. If you want to buy a property, the best thing you can do, the more the deposit you've got, the better for you. So that is why I would always say it is better you have more deposits. If you do not have enough deposits, then why not go for the shared ownership so that you are able to afford a share? You get that? So instead of going for 5% deposits, I will advise you go for a shared ownership so that you are able to deposit a higher percentage. Another thing you can do is this: research local property. Research the local market, okay? Look at sold prices in the same development and in other neighboring homes. Is the price realistic? Just go to Rightmove or to Zoopla, type in that postcode or the postcode of the area around that new build, and then you check the prices of the houses there. Okay, what range? How different is it from the one you want to buy? Is the difference a lot? Is it up to £20,000 difference? Because if it is, it means that it will come back. Although I know that, all houses are not the same. They will differ in their prices, I understand. But if it is the same kind of property, check when that property was built. 5 years down the line, how much is that property? So another thing you should also do is to be wary of incentives. Always negotiate the base price instead of taking freebies. Ask, if I took none of these deals, how much could you actually knock off from the whole price of the property? Another thing you can do is this: buy for the long term. Negative equity is only a problem if you need to sell soon. Plan to stay for at least 5 to 7 years in that property to ride out short-term dip. Okay, you know, I've explained this when it comes to investing in stocks and shares. I keep telling you, it's a long-term investment. So if you are doing this kind of investments, make up your mind to do it for a longer period of time, because that is only when whatever dips that may have occurred, it will all balance out. Okay, what else do? You focus on high growth areas. Buy in areas that have strong local amenities, economies, regeneration plans, good transport. Avoid developments in areas with tons of empty flats. Avoid developments that do not have high demand. Okay, another thing you can do is to choose houses over flats as much as possible. Houses tend to appreciate more steadily. New built flats, I don't know, for some reasons, especially the leasehold ones, they have high service charges and their value easily drops. Okay, now let's talk about one of the most underrated tools in your home buying journey: your mortgage strategy. Because when it comes to negative equity, your mortgage can either make the problem worse or it can give you the protection that you need. And this is a very important one to consider. Now, the kind of mortgage you are using matters a lot. When you buy a new build, you are often paying a premium, and the first few years are the riskiest for price drops. Now, that's why I recommend a 5-year fixed rate mortgage, not just a 2-year deal. And I'm going to explain why. This is because it locks in your monthly payments for longer, and therefore it protects you from interest rate hikes. Of course, this is only applicable when you are able to lock in a good rate. Okay, let's say you were able to get a very good interest rate, then I always advise that you go for the 5-year fixed mortgage, because now you've got that stability for a longer period of time. A whole lot of times we are hoping that the interest rate is going to come down when we want to remortgage and all of that, but most of the times it doesn't change, or it even goes up. Well, what I'm trying to say is this: if you got a very good rate when you were applying for your mortgage, then it's always better to lock it in for a higher period of time. Because if you are unlucky and after 2 years you want to remortgage, and then negative equity has happened to that property, and plus the interest rate, if you are unfortunate, if the interest rate is higher when you want to remortgage, then you are going to really feel that dip. You will feel that negative equity. But if you have locked it up for a longer period of time, maybe 5 years, there is high chances that by the time you want to remortgage, the value of the property must have increased, and it's going to help you to get a better value when you are remortgaging. However, I must mention, most of the times 5 years fixed mortgage comes with a price, because hey, even the banks know that you are the one, they are the one that may lose out, most especially if the interest rate goes up and you are still benefiting from your low interest rate. So it comes with a price, so make sure you check this out with the lender. Another thing you can do is to choose a mortgage with a reasonable exit plan and portability. So let's say you want to move before your 5 years are up. That's why it's smart to choose a mortgage that is portable, meaning you can take this mortgage with you to a new home. So if something happens and you want to buy another property, you can also continue with that mortgage. Also look at the early repayment charges. Some lenders will charge huge fees if you want to pay off, or if you want to switch your mortgage early. So look for deals that have good early repayment charges, not overly too high. Or you can also look for a fair flat rate that you can plan around with, just because it's good for you to have all these things in mind. Overpay strategically. So this one is very powerful. Make small regular overpayments on your mortgage. Okay, this video is overpacked, I understand, but I need to say it out there. Most lenders will allow you to pay at least 10% of your balance every year with no penalty. So as much as possible, try to pay this, because whatever that's 10% or whatever it is, even if you are not able to pay up to 10%, whatever it is you are paying in every year, it is going to your capital and not to the interest. Now I'm going to explain to you why this matters a lot. This matters a lot because that money that is going to your capital, it is going to be reducing your interest. Do you get that? Now when you get a mortgage and you are paying monthly, I want to make this whole thing clear. It is called a sliding scale. Now, sliding scale means that whatever you are paying, a higher percentage of it is going towards your interest. A much lower percentage is going towards your capital. So you see how these people are using us to be rich and wealthy. So now at least you know that 10% extra that you can pay every year, it goes towards your capital, and it will make a whole lot of difference. So try as much as possible to make use of that. Okay, don't let that opportunity pass by. Anytime you get into a mortgage, try as much as possible to make that overpayment. Utilize that 10% that you are able to pay each year. Now, anything above 10%, if you want to pay anything above 10% in a particular year, then it will come with a charge. So what does overpaying do for you? It reduces your total interest over time. It brings your loan down faster, and it helps you to build equity quicker, which is your buffer if prices fall. Okay, now even if you're able to pay £100, £50, it will make a lot of difference over 5 years. So don't stop doing it, keep doing it. That is why I always say this: affordability matters a lot when you are going into a mortgage. Do not focus on the deposits. The deposit is not the main thing. As far as I'm concerned, the deposit is not the main thing. The main thing is your monthly repayment. For me, I will always target something not more than whatever I'm able to afford as my rent. As a matter of fact, I would want even something less, because now I am going to consider the fact that I am owning the house. I own the house. I am a landlord, and there's a possibility of, miscellaneous expenses like home repairs, home maintenance. So I wouldn't want to, pay more than my rent. Unless, of course, my circumstances has changed for good and I am earning more. And even if I'm earning more, my dear, there are a whole lot of other investments that I can put my money into. I mean, we diversify. We don't just put all our money in one thing. Probably because you've got a property now, you want all your salary or all your extra gains to go into that property. I mean, if I can get the lowest monthly repayment available, that is what I will go for. Because if I go for that, I am able to save more. I am able to invest in a whole lot of other things. We need to be wise in all these things. So don't just focus on deposit. Oh, I've got the money to deposit. And then you are not checking your affordability. What are you paying every month? How much is it? Are you able to pay that extra to go into your capital? Have a look at it this way. Let's assume that you are able to get a monthly mortgage repayment of £700 in a month, and where you were renting before, let's assume it was £900 or even £1,000, whatever it is. If you get this monthly repayment of £700, my dear, you can even decide to pay extra £200 as your overpayment going to your capital. It makes more sense. Now, even if I don't want to pay up to that extra 200 to go into my capital, I can make it 100. If that 100 is going to my capital and I'm keeping the other 100 as by emergency, just in case of any repairs or maintenance that may come, I mean, you've got something for emergency fund. And then you still have something extra for any other investment you want to do. You don't want to, because you've bought a house, you want everything to go in there because you're now struggling to pay your monthly repayment. Hey, we need to wisen up, because I've seen a whole lot of people going into a mortgage because they've given you a particular loan amount. Oh, you are able to, I'm able to borrow you 300,000 or 400,000. You want to utilize everything, and then you're going for a house of that same amount, and your monthly repayment could be maybe something above 1,300 or so, and your salary is still the same. Probably your rent was 1,100 or even 1,000, and now your monthly mortgage repayment is 1,300. And my sister, my brother, you've not even considered your monthly you've not considered the fact that there is maintenance and repair that could come up within the year, and whenever that happens, you know how much it may cost you, and then you have to impute it into your monthly repayment. That is how people go into bankruptcy. That is how people go into debt. There is no other way. When your lifestyle is much more than what you are earning, it is called lifestyle inflation. So when you are living above your means, you don't even know when you start doing all of those things. So please, I think I feel like I need to say this more, because a whole lot of people are getting into this trap, and it is not good. It is not good. We need to be financially aware. We need to educate ourselves financially. Do the math or consider a whole lot of things. Another thing you can do is to get a broker advice, especially with new builds. Okay, don't do it alone. A good independent mortgage broker. Hear what I said. Independent mortgage broker will help you. Most of the times, these mortgage brokers, they are attached to a particular lender or housing agency, and everything seems a whole lot manipulated, and they don't actually give you the advice that you are paying for. So please find an independent mortgage broker. So what does a good independent mortgage broker do? They will help you compare fixed rate deals and whatever cost is associated with them. They will help you understand which lenders are new build friendly. They will help you navigate complex options like shared ownership, help to buy, exit strategies, any kind of charges that is associated with that. They will help explain all those small prints, any points that you may have missed. Unfortunately, a whole lot of them don't do that except you ask them questions, and that is why this channel exists. I am saying all these things because if you have the knowledge, you will know the right questions to ask, because most times if you do not ask them, they do not tell you. So know the right things and know what to ask pertaining to your specific situation. Okay, you make it personal. As we are sharing all this information here, you gain the knowledge, you know the right questions to ask, because if you do not know, you will not even ask in the first place. So I am hoping that you are taking notes. So I want you to remember this: a mortgage is not just about getting approved, it's about protecting your future. And the right mortgage will not just help you buy a home, it will help you stay in control of your finances no matter what the market does. Okay, I still love new builds anyway. The fresh start, the energy efficiency, the simplicity, the freshness, they are unmatched for me. But buying blind is never smart. Okay, I won't do that. If you are strategic, you can enjoy the best of both worlds: a beautiful new home and a long-term financial security. I want you to please drop a comment. Are you considering a new build? Have you experienced negative equity? I would love to hear your story. Okay, so don't forget to like, subscribe, and share this video with someone about to buy their own first home. Knowledge, they say, is power, and in this housing market we need all the power we can get. Okay, I'll see you in my next video. Take care of yourself. Bye bye.